Welcome to Lesson 03, Economic Indicators. In the first two lessons, we mapped the flow of capital and identified the major financial institutions. Today, we learn how professionals read the economy. Economic indicators are numbers that help us understand growth, inflation, employment, production, and trade. Economic indicators are not just numbers. They are signals that help investors, companies, and policymakers understand where the economy may be heading. Here is the key question: why can good economic news sometimes hurt the market? If inflation is too high or growth is too strong, investors may expect the central bank to keep interest rates high. So the market does not only react to whether a number is good or bad. It reacts to what the number implies. A strong market professional does not read one indicator in isolation. The key skill is connecting growth, inflation, employment, and external demand. Economic indicators matter in real financial work. A bank may use them to judge credit risk. An asset manager may use them to change asset allocation. A company may use them to forecast demand, inventory, and hiring. Indicators turn broad economic conditions into practical business decisions. GDP is useful, but it is often backward-looking. By the time GDP is released, businesses and investors may already be reacting to newer signals. GDP stands for Gross Domestic Product. It measures the total value of goods and services produced in an economy. Real GDP adjusts for inflation, so it gives a cleaner view of growth. When analysts say the economy expanded or contracted, they are often talking about GDP growth. CPI is important because inflation changes purchasing power, interest rate expectations, and the cost of doing business. CPI stands for Consumer Price Index. It measures how consumer prices change over time. Headline CPI includes all items, including volatile food and energy prices. Core CPI often excludes food and energy, so analysts use it to understand underlying inflation pressure. Core CPI matters because it removes volatile items. That helps analysts judge whether inflation pressure is temporary or becoming more persistent. The unemployment rate helps us understand the labor market. A low unemployment rate usually signals a strong economy. But if wage growth is too strong, it may add inflation pressure. Employment data is often a lagging indicator because companies usually change hiring after the economy has already turned. Unemployment often reacts with a delay. Companies may wait before hiring or firing, so labor data can confirm a trend that started earlier. PMI stands for Purchasing Managers Index. It is based on surveys of business managers. A reading above 50 usually signals expansion, while a reading below 50 usually signals contraction. PMI is useful because it can give an early signal before official GDP data is released. PMI is valuable because it comes from purchasing managers who see orders, inventories, production plans, and supplier conditions early. For Taiwan, export orders are especially important. They show global demand before actual exports are shipped. Because Taiwan is deeply connected to technology supply chains, export orders can reveal changes in demand for electronics, semiconductors, and global manufacturing. Export orders are especially important for Taiwan because they connect local manufacturers to global technology demand and the semiconductor cycle. A leading indicator gives an early signal about where the economy may be heading. PMI and export orders are often treated as leading indicators. A lagging indicator confirms what has already happened. Unemployment is often lagging. Professionals compare both because timing matters. Leading indicators point forward. Lagging indicators confirm what has already happened. Both are useful, but they answer different questions. Markets usually react to the difference between actual data and expected data. If CPI is higher than expected, bond yields may rise. If GDP is weaker than expected, investors may worry about recession. The surprise is often more important than the number itself. When indicators conflict, do not force one simple conclusion. A slowing PMI with sticky inflation may suggest slower growth but continued policy caution. Now let us focus on English. Use rise to when you describe the final level. For example, CPI rose to 3%. Use rise by when you describe the amount of change. For example, CPI rose by 0.3 percentage points. This distinction is essential in financial reporting. The phrase rise to tells us the final level. For example, inflation rose to 3% means 3% is the new level. Two useful noun phrases are growth of and increase in. You can say GDP recorded growth of 2%. You can also say there was an increase in export orders. For negative data, use a decline in, a drop in, or a contraction in. The phrase rise by tells us the size of the change. Inflation rose by 0.3 percentage points focuses on the movement, not the final level. Avoid vague data English. Do not only say prices went up. Say CPI rose by 0.3 percentage points. Do not only say the economy is bad. Say GDP growth slowed, PMI fell below 50, or export orders contracted. Professional English is specific. Growth of is often used with GDP, revenue, exports, or earnings. It turns the number into a professional measurement phrase. Here is a mini case. Taiwan export orders fall for 2 months, PMI drops below 50, but CPI remains stable. What should a bank watch? It should watch corporate revenue, inventory levels, cash flow, and credit risk. Weak demand can become a banking issue if borrowers depend heavily on export revenue. Increase in is useful when the noun is the focus. You can say an increase in export orders, an increase in unemployment, or an increase in prices. Your output task is to give a 60-second market update. Use one growth indicator, one inflation indicator, and one market implication. For example, GDP growth slowed, while core CPI remained elevated. This may keep interest rates higher for longer and pressure borrowers. A good market update should mention the indicator, the direction, the size of the move, and the possible implication for policy or markets. Today, we learned how to read key economic indicators. GDP shows growth. CPI shows inflation. Unemployment shows labor market conditions. PMI and export orders can give early signals. Most importantly, we learned how to explain data using precise English. I will see you in Lesson 04. Your final task is to explain Taiwan's economy using at least one growth indicator, one inflation indicator, and one external demand indicator.